Look, we need to address the elephant in the room. Yesterday felt like a crime scene. We watched silver get slammed in a violent COMEX flush, a vertical drop that looked like someone pulled the plug on the entire bull market. If you were staring at your screen feeling that pit in your stomach, wondering if the silver squeeze just turned into a silver trap, you aren't alone. The headlines are already calling it a collapse. But I want you to stop, take a breath, look away from the red candles and look at the structure. Because while the paper market was screaming, "Get out," the actual market was doing something much more calculated. I want you to focus on one specific number. 83. That wasn't just a random bounce. That wasn't a lucky coincidence. While the panic was peaking and the weak hands were hitting the sell button, the bleeding stopped dead at exactly $83. Why? Because $83 is no longer just a price. It's a strategic beachhead. In technical terms, we are seeing the polarity principle in its purest form. We spent months fighting to turn $83 from a ceiling into a floor. Yesterday wasn't a crash, it was a stress test of that floor. The bears threw everything they had at it, millions of ounces of paper silver dumped in minutes, and $83 didn't just hold. It absorbed the blow. What you saw was a liquidity grab. The big bullion banks triggered your stop losses to reclaim cheap ounces, but they ran into a wall of smart money. The industrial giants and institutional whales aren't selling at 83. They were waiting there with their buckets open. They let the panicked retail traders sell right into their hands. Today, the paper speculators are gone, and the structural floor is set. In this video, I'm going to show you why this 83 defense is the most bullish signal we've seen all year, and why the flush actually cleared the path for the next leg to 100. The trap has been set, but it's not for us, it's for the bears. To understand why the $83 level held with such defiance, we first have to perform an autopsy on the crime scene that was yesterday's price action. To the untrained eye, it looked like a spontaneous collapse of confidence, a sudden realization by the market that silver was overvalued. But if you've spent any time studying the plumbing of the COMEX, you know that markets of this size don't just fall vertically without a catalyst. What we witnessed was a masterclass in financial engineering, a calculated flush, designed to exploit the very mechanics of how most retail investors trade. This is the world of high-frequency trading and the predatory practice known as stop hunting. And if you don't understand how it works, you are essentially playing poker against someone who can see your cards. Imagine for a moment that you're a mid-level algorithm at a major bullion bank. Your objective isn't to predict the price of silver in 5 years. Your objective is to find liquidity. In a market that has been trending upward as aggressively as silver has, liquidity, meaning a large cluster of sell orders, is usually found just below the most obvious support levels. As silver climbed toward the mid-80s, thousands of retail traders and small-scale speculators moved their stop-loss orders up to protect their profits. They placed those orders at logical psychological levels, 84.50, 84 $, and especially just below the recent breakout point. To a bullion bank looking to reclaim physical metal or cover a massive short position, those stop-loss orders aren't just safety nets for traders. They are a concentrated pool of guaranteed sell orders waiting to be triggered. The deflush begins not with a change in fundamentals. There was no news of a massive new silver mine opening or a sudden drop in solar panel production, but with a coordinated spoofing or a sudden dump of paper contracts during a low-volume window. By hitting the bid with enough force in a matter of seconds, these institutional players create a temporary vacuum. As the price ticks down rapidly, it hits that first pocket of retail stop losses. This is where the domino effect takes over. A stop loss order, once triggered, becomes a market sell order. It doesn't care about the value of the silver. It only cares about getting out at the next available price. When hundreds of these orders fire simultaneously, they push the price down further, which triggers the next layer of stops and then the next. This is the mechanical part of the flush. It is a self-reinforcing feedback loop that creates a vertical line on the chart. To the person watching their phone at home, it looks like a total market rejection. They see the price falling $1, $2, $3 in a heartbeat, and the lizard brain takes over. This is exactly what the smart money wants. The goal of the stop hunt is to create enough technical damage that the weak hands, those trading on high leverage or pure emotion, capitulate. The banks aren't just triggering automated orders, they're inducing manual panic. They want you to believe the silver dream is over, so that you will hand over your position to them at a deep discount. During this chaos, the high-frequency trading, HFT systems, are working at speeds the human eye cannot comprehend. These algorithms are programmed to sniff out where the liquidity gaps are. They can see the order book, and they know that if they can just push the price past a certain technical threshold, the market's own internal mechanics will do the rest of the work for them. Yesterday, that threshold was the $84 order mark. Once that level snapped, the algorithms knew there was a liquidity desert between $84 and $83. By accelerating the selling in that gap, they created the free fall effect. It is a violent, predatory process, but it serves a very specific purpose for the big players. It cleans the market. It removes the over-leveraged speculators who are standing in the way of a more sustainable move higher. However, the reason this specific flush is so fascinating is that the machine finally met its match. Usually a flush like this will continue until it hits a level of such extreme exhaustion that it takes days or weeks for the price to recover. But as the price plummeted through $84 and neared $83, something unexpected happened. The sell orders from the triggered stops were met by an equal and opposite force of buy orders that had been quietly sitting on the books of industrial hedgers and long-term institutional allocators. The banks were fishing for liquidity, but they ended up catching a shark. This is the part of this mechanics that the mainstream media never talks about. They focus on the volatility and the plunge, but they ignore the absorption. When you see a high volume spike at the bottom of a vertical drop, that is the sound of the smart money slamming the door shut. It represents a transfer of ownership. The paper silver, the contracts held by people who were scared or over-leveraged, was transferred into the hands of people who actually understand the physical deficit and the macroeconomic reality of 2025. The flush didn't fail because the banks were nice. It failed because the value proposition at $83 was so high that it overrode the downward momentum of the algorithms. We have to understand that the COMEX is essentially a giant theater of illusions. It is a place where 100 ounces of paper silver are traded for every 1 ounce of physical silver that actually exists in a vault. The flush is a tool used by the magicians to keep the price of that paper in check, to ensure that the people who actually run the physical markets can continue to accumulate at reasonable prices. When you see a move like we saw yesterday, you aren't looking at a reflection of silver's worth. You're looking at the margin call madness that results when a paper-heavy market is forced to reconcile with a physical-heavy reality. By the time the dust settled and the price stabilized at $83 SIR, the damage to retail sentiment was done, but the structural integrity of the bull market was actually improved. The froth was gone. The people who bought the top because of a YouTube thumbnail or a fear of missing out were flushed out. In their place are now strong hands, entities with deep pockets who have no intention of selling at $85 or even $90. They are looking at the 100-plus horizon. The mechanics of the flush are designed to make you feel small, powerless, and wrong. But once you realize that the vertical drop was nothing more than an automated liquidity grab, the fear disappears. You start to see the $83 level not as a sign of weakness, but as the moment the market's biggest players decided to stand their ground. The machine tried to break silver's back, but all it did was prove how strong the new floor really is. To understand why the $83 level acted as such a violent repellent to the downward momentum, we have to look past the immediate panic and examine the memory of the market. In the world of high-stakes commodity trading, price is never just a number. It is a historical record of where buyers and sellers reached a consensus, or a stalemate. For months, the $83 mark was the ultimate ceiling, a psychological and technical barrier that seemed impenetrable. It represented the 52-week high, a peak where every rally of the past year went to die. When a market spends that much time banging its head against a specific price point, that price becomes etched into the collective consciousness of every trading algorithm and institutional desk in the world. This is why, when we finally broke above $83 weeks ago, the entire character of the silver market changed. But, as any veteran trader will tell you, a breakout is never truly real until it is tested from above. Yesterday was that test. When the COMEX flush began, the market wasn't just falling into an abyss, it was returning to the scene of its greatest struggle. In technical analysis, we refer to this as the confirmation of the breakout. For $83 to transform from a multi-month ceiling into a permanent floor, the market had to prove that the people who were selling at $83 last year are now the same people willing to buy it at $83 today. The fact that the price hit that level and bounced with such ferocity tells us that the polarity shift is complete. The very people who spent the last 12 months keeping silver under $83 have now flipped their bias. They've realized that the macro environment has shifted. Inflation is stickier than the Fed admitted, the industrial deficit is widening, and the BRICS nations are moving toward a commodities-backed settlement system. Consequently, $83 went from being too expensive to the ultimate bargain in the span of a single trading cycle. If you look at the daily and weekly charts, the $83 level aligns almost perfectly with the 50-day moving average. and a series of Fibonacci retracement levels that institutional buy zones are built upon. These aren't just lines on a screen for hobbyists. These are the parameters programmed into the billion-dollar black box algorithms used by the world's largest hedge funds. When silver was trading at $87 or $88, those funds weren't chasing the price. They were waiting for a mean reversion. They knew the market was overextended, and they were content to sit on their hands until the price came back to a level of fair value, where the risk-to-reward ratio made sense. $83 was that golden entry. While retail traders were watching the $3 drop and feeling like they were losing their shirts, the institutional desks were seeing a buy signal flash on their monitors. They saw a high probability entry point at a proven historical pivot, and they stepped in with enough capital to absorb every single panic sell order that hit the tape. This is what we mean when we call it a line in the sand. It's a point of maximum vested interest. If the price had slipped to $82 or $81, it would have signaled that the breakout was a fake out, and that silver was headed back into the doldrums of the $70 range. The smart money couldn't let that happen. By defending $83, they are protecting their own massive positions that were built during the breakout phase. They are signaling to the rest of the market that the new regime of higher silver prices is here to stay. This creates a psychological feedback loop. Now that the market has seen $83 hold through a violent flush, it gains a shield of confidence. Traders who were hesitant to buy at $85 are now looking at $83 as a safe harbor, a place where they can place their own stops with the knowledge that a massive wall of institutional buying power is standing right there with them. The volume profile at this level is equally revealing. When you look at where the most silver has actually changed hands over the last quarter, a massive cluster or mountain of volume appears right at the $83 to $84.50 range. This tells us that there is a massive amount of vested interest at this price. These aren't just numbers. These are contracts. These are millions of ounces that people have committed their capital to. When the price returns to a high volume cluster like this, it's like a magnet. It's where the market feels comfortable. The reason the price stopped falling isn't just because of technical lines. It's because at $83, the number of people who felt they were getting a deal finally outweighed the number of people who were scared. Furthermore, we have to consider the industrial floor. Unlike gold, silver is an essential industrial commodity. Solar manufacturers, EV battery producers, and electronics giants don't care about COMEX stop hunting or paper manipulation in the short term. They have production schedules to meet. They have buy orders layered into the market to ensure they have the physical metal they need for the next 6 months. For these industrial players, $83 was likely their target for a restock. When the paper speculators dumped their contracts and drove the price down to that level, the industrial buyers simply saw it as a discount on their necessary raw materials. They aren't trading for a $1 profit. They are trading for survival. Their massive limit order buying power created a physical floor that the paper shorts simply couldn't penetrate. So, as we look at the wreckage of yesterday's trading session, we shouldn't see a sign of weakness. We should see the $83 level as a monument to the market's newfound strength. It is the definitive boundary between the old silver market of the last decade and the new market that is preparing to challenge 100. The line in the sand has been drawn. The bears tried to cross it, they were bloodied, and they were forced to retreat. What was once a ceiling that kept us trapped for a year has now become the foundation for the next leg up. The message from the charts is clear. The breakout is confirmed, the floor is solid, and the smart money is now firmly in control of the narrative. To understand why the $83 floor held so firmly against the tide of red candles, we have to look behind the curtain at the data that the mainstream financial news often ignores or misinterprets. We have to look at the ghost in the machine, the commitment of traders, COT report. If the price action is the what of the market, the COT report is the who. It is the weekly confession of the market's biggest players, mandated by the CFTC, and it reveals exactly who was dumping paper and who was quietly standing there with their hands open to catch it. In the wake of the $83 defense, the most recent data tells a story that is diametrically opposed to the silver is dead narrative being peddled by the bears. To read the COT report properly, you have to understand that the market is divided into 3 distinct psychological camps: the commercials, the non-commercials, large speculators, and the non-reportables, small speculators. In the silver market, these groups rarely agree, and their behavior during a flush like the one we just witnessed is incredibly revealing. The non-commercials, which mostly consist of hedge funds and managed money, are often referred to as trend followers. They are the hot money. They buy when the price is rising, and they sell when the price is falling. To them, silver isn't a strategic asset. It's a ticker symbol used to generate quarterly returns. When the COMEX flush began, These were the players who hit the sell button. Their algorithms are programmed to exit positions the moment a specific volatility threshold is crossed. And as the price tumbled from $86 toward $84, these large speculators were the primary source of the selling pressure. They were the ones panicking because their paper wealth was evaporating in real time. But then we look at the commercials. This is where the smart money lives. The commercial category is made up of two powerful subgroups: the producers, the miners who actually dig the silver out of the ground, and the swap dealers, the big bullion banks like JP Morgan or HSBC. Traditionally, the commercials are net short because miners use the futures market to lock in prices for their future production. However, something fascinating happens during a structural bottom. When the price of silver hits a level that is too low relative to the physical reality of the market, the bullion banks stop selling and start covering. Covering a short position requires buying back contracts. As the price neared $83, the COT data suggests that the bullion banks, the very people often accused of manipulating the price lower, suddenly flipped their behavior. They became the primary buyers. This is the great irony of the silver market. The banks use the panic of the hedge funds to close out their own short positions at a massive profit. They flush the market to trigger the sell orders of the speculators, and then they quietly step in to buy those contracts back at 83. This is why we call it the ghost in the machine. While the retail world sees a crash, the banks see a rebalancing. They are moving the risk from their books onto the books of the panicked speculators. The commercials are almost always right at the extremes of the market. They are the most informed participants because they deal in the physical metal every single day. If the banks and producers decided that $83 was the level to stop selling and start buying, that should tell you everything you need to know about where they think the price is headed next. Then we have the small speculators, or the non-reportables. This is often referred to as the dumb money, consisting of retail traders and small hedge funds. Historically, this group is the most bullish at the exact top and the most bearish at the exact bottom. In the hours leading up to the $83 defense, the sentiment among this group was one of pure capitulation. We saw a massive spike in liquidations, meaning traders weren't just selling, they were being forced out of their positions by margin calls. They bought the FOMO at $86, and they were flushed at $83. Their loss became the bullion bank's gain. This transfer of ownership is a necessary part of a bull market's health. It's like a forest fire that clears out the dead brush so that new, stronger growth can take place. By clearing out the weak hands of the small speculators, the market has replaced nervous, leveraged money with the strong hands of institutional allocators. What the COT report is currently signaling is a washout of the speculative longs. When the net long position of the hedge funds drops significantly while the net short position of the commercial shrinks, it creates a coiled spring effect. There is now a massive amount of sideline capital waiting to get back into the market. The hedge funds that sold at $84 and $85 are now watching $83 hold with frustration. Eventually, they will have to buy back in at higher prices to avoid missing the next leg up. This is the mechanical fuel for a short squeeze. The smart money has already positioned themselves at the $83 floor. And now they are simply waiting for the speculators to realize their mistake and start chasing the price again. We also have to look at the swap dealer category within the disaggregated COT report. These are the desks that facilitate trades for the world's largest industrial users, the companies that need silver for solar panels, semiconductors, and medical devices. These entities don't care about the daily noise of the COMEX. They care about securing physical supply. The data shows that as silver hit the $83 mark, the long positions for these industrial-linked desks began to swell. This confirms that the floor isn't just a technical or psychological construct. It is backed by industrial necessity. The manufacturers saw $83 and decided to front-run the market, locking in their costs before the supply-demand deficit drives prices into the triple digits. Ultimately, the COT report proves that yesterday's flush was an artificial event, a paper storm that failed to dampen the physical fire. The ghost in the machine is now leaning heavily toward the bullish side. The speculators have been humbled, the banks have covered their shorts, and the industrial users have built their buy walls. When you understand the motives of these different players, you realize that $83 wasn't just a bounce, it was a transition of power. The paper manipulators took their shot, but the physical buyers stood their ground. To understand why the 83 support level is a structural floor and not just a technical one, we have to look at the massive fracture that has opened up between the world of paper and the world of metal. Yesterday, as the COMEX screen flashed a violent $3 drop in a matter of hours, a curious thing happened at the retail and wholesale bullion desks across the globe. The price of a physical silver eagle didn't move an inch. In fact, in many cases, it went up. This is the phenomenon of premium decoupling. And it is the ultimate proof that the price discovery mechanism on the COMEX is becoming increasingly untethered from the reality of physical supply and demand. When we talk about the price of silver, we are usually referring to the most active futures contract on the COMEX, a digital agreement to buy or sell 5,000 ounces of silver at a future date. This is the paper price. It is influenced by interest rates, margin hikes from the CME, and the high-frequency algorithms we discussed earlier. But the physical price, what you actually pay to get a 100-ounce bar or a monster box of sovereign coins into your hands, is the spot price plus a premium. Usually, these two move in tandem. When paper goes down, the total cost of physical follows. But during the flush toward $80, that correlation snapped. As the paper price plummeted, the premiums charged by dealers, the extra amount you pay over the spot price to cover fabrication, logistics, and profit, simply expanded to absorb the drop. If silver was $86 with a $4 premium, and the paper price fell to $83, the premium didn't stay at $4, it spiked to $7. The end result? The cost to buy real, tangible silver remained effectively stuck at $90. This tells us something profound. The people who actually own the metal, the refiners and the wholesalers, do not believe the COMEX price. They are refusing to lower their prices just because a few hedge funds got margin called in New York. They know that the physical market is in a structural deficit of nearly 200 million ounces, and they aren't about to give away their dwindling inventory at a paper discount. This divergence is a massive red flag for the bears. In a healthy market, the paper and physical prices should be tightly linked. When they decouple, it's a sign of physical tightness. The wholesalers are seeing the drawdowns in the London LBMA vaults and the COMEX registered inventories, and they are front-running a shortage. We are seeing record volumes of silver being delivered out of COMEX vaults, not just traded as paper, but actually loaded onto trucks and moved, driven by industrial giants in the solar and AI sectors who are terrified of being left without raw materials. This is why the $83 level is so significant. It represents the point where the paper shorts ran into the physical reality. The bullion banks can print as many paper contracts as they want to push the price down, but they cannot print silver. When the paper price hits a level like $83, it triggers a massive arbitrage opportunity. Smart money realizes that paper silver is now too cheap compared to the physical metal, so they buy the paper contracts with the intent to stand for delivery. They want to take the metal out of the system. This creates a nightmare scenario for the banks, who are then forced to scramble for physical ounces to fulfill those contracts, ultimately driving the price right back up. Think about the psychology of the stacker, or the long-term investor, during this flush. Unlike the speculator who is trading on 20x leverage and has to sell when the price drops 2%, the physical owner is looking at the long game. When they see the paper price drop to $83, but their local dealer is still sold out or charging massive premiums, it reinforces their diamond hands. It proves to them that the crash is an illusion, a digital head fake designed to shake them out of the most valuable asset they own. They see that the spread between paper and physical is widening, which is exactly what happens right before a major currency or market reset. This great divergence is also being fueled by the East. While Western traders were panicking and dumping paper, the Shanghai Gold Exchange, SGE, was trading silver at a significant premium to the COMEX. In late 2025, we might have seen the Shanghai premium reach as high as 10 to 15% over New York prices. This means that if you can buy silver in New York for 83 and sell it in China for 93, the metal is going to move east. And once it goes to China or India, it doesn't come back. The COMEX is essentially a leaky bucket, losing its physical inventory to the east every time the paper price is manipulated too low. The $83 difference was the bucket hitting the bottom. By the time the smoke cleared yesterday, the message was undeniable. The COMEX no longer has the power to dictate the value of silver in a vacuum. The physical market has taken over the steering wheel. The fact that premiums stayed high and inventories continued to shrink despite the bloodbath on the screen proves that the smart money is no longer playing the paper game. They are playing the metal game. They aren't looking for a $1 profit on a screen. They are looking to own the most undervalued essential industrial and monetary metal on the planet before the paper-to-physical bridge collapses entirely. $83 is the line where the physical buyers said no more, and that is why the flush didn't just stop, it reversed. While the paper speculators in New York and London were busy setting fire to their portfolios during the $83 flush, a very different kind of player was watching the screens with cold, predatory intent. These aren't the hedge fund managers or the day traders looking for a quick flip. These are the procurement officers and supply chain directors for the world OSS, largest solar panel manufacturers and green energy conglomerates. To them, silver isn't a speculative play. It is a critical industrial component, as essential as the silicon wafers or the glass that makes up a photovoltaic cell. And for these industrial giants, the drop to $83 or didn't represent a crash. It represented a rare, narrow window to secure the physical metal they need to survive the most significant supply-demand deficit in modern history. To understand the industrial floor, you have to understand the sheer scale of silver consumption in the renewable sector as of late 2025. We have moved far beyond the days when solar was a niche player in silver demand. Today, the solar industry alone is consuming over 150 million ounces of silver annually, and that number is accelerating. Even as engineers work tirelessly on thrifting, the process of using less silver per cell, the sheer volume of global installations is overwhelming those efficiency gains. In 2025, the transition to high-efficiency technologies like TOPCon and HJT, heterojunction cells, has actually increased the cone to silver loading per watt. These advanced cells require up to 22 milligrams of silver per watt, compared to the older, simpler models. When you multiply that by the hundreds of gigawatts of solar capacity being installed across China, India, and the United States, you aren't just looking at a market, you're looking at an industrial vacuum. For a solar manufacturer, the price of silver is a massive line item in their cost of goods sold. When silver was pushing $88 and $90 earlier this month, these companies were feeling the squeeze on their margins. They weren't buying, they were waiting. They were in front-running the market by setting massive buy limit orders at the 83 support level, the very level we have identified as the line in the sand. When the COMEX flush hit and the paper price plummeted, these industrial limit orders were triggered in massive blocks. And while a retail trader sees the price falling and thinks, I need to get out, a manufacturer sees the price falling and thinks, I need to lock this in before it goes to 100. This is the industrial floor in action. It is a wall of buying power that doesn't care about chart patterns or stop hunting. It only cares about securing physical delivery. We are currently in the 5th consecutive year of a structural silver deficit. Estimates for 2025 suggest a shortfall of over 200 million ounces, roughly equivalent to the entire annual output of Mexico, the world's largest producer. In an environment of such extreme scarcity, the just-in-time delivery model for industrial raw materials has collapsed. Manufacturers are now moving toward a just-in-case model, which means they are actively stockpiling metal whenever they see a dip. They know that if they don't own the silver, they can't build the panels. And if they can't build the panels, their multi-billion-dollar factories sit idle. To an industrialist, paying $83 for silver when the alternative is a factory shutdown is an absolute bargain. This industrial panic is being further exacerbated by the green energy arms race. China, which refines and consumes the vast majority of the world's silver, has begun implementing tighter export licensing requirements to ensure their own domestic industries are supplied first. This has sent shockwaves through Western manufacturers, who are now realizing that the global pool of available silver is shrinking far faster than the COMEX inventories suggest. When you see the price hit $83 and bounce like it's hitting concrete, you are seeing the result of this geopolitical scramble. The manufacturers are essentially defending the price because they cannot afford for it to stay low enough to discourage mining or for it to be bought up by someone else. Furthermore, the smart money in the industrial sector is increasingly aware of the paper-to-physical divergence we discussed earlier. They see that the LBMA and COMEX vaults are being drained of their registered silver at a record pace. They know that a large portion of the silver reported in these vaults is already spoken for. It exists, held in ETFs or owned by private individuals who have no intention of selling. This means the true available supply for industrial use is even smaller than the headlines suggest. By buying at $83, these companies are effectively arbitraging the paper market. They are using the artificial dip created by paper speculators to snatch up physical metal that they know is worth far more in the real world. Ultimately, the solar factor has fundamentally changed the DNA of silver price action. In previous cycles, a $3 drop would have led to weeks of consolidation. But in 2025, silver has an industrial pulse. It has a level below which it simply cannot stay because the industrial demand is too voracious. $83 has become that dream entry for the big players. They let the weak hands sell into their hands, and as soon as the paper selling exhausted itself, the industrial buyers stepped in and built a floor that no amount of paper manipulation can break. They aren't just buying silver, they are buying the future of energy, and they've decided $83 is the price they are willing to pay to own it. To navigate the silver market successfully in 2025, you have to develop a psychological armor that most retail traders simply do not possess. You have to learn to love the red candles as much as the green ones, because in a bull market, volatility is not your enemy. It is the mechanism by which the market transfers wealth from the impatient to the disciplined. This brings us to the most difficult skill in the investor's toolkit, distinguishing between a genuine trend reversal and a predatory volatility shakeout. If you can't tell the difference, you will find yourself selling at the exact moment the smart money is buying, effectively subsidizing the profits of the very institutions you're trying to beat. A volatility shakeout, like the one that just slammed silver into the $83 support, is characterized by its speed and its surgical nature. It often feels like a vertical drop because it is designed to trigger the maximum amount of pain in the shortest possible time. In a shakeout, the price action is impulsive, but it lacks structural follow-through. It's a flash in the pan meant to hunt for stops. A true trend reversal, by contrast, is a slow grinding process of exhaustion. It's not a sudden cliff. It has a rounded top or a series of lower highs and lower lows that build over days or weeks. When you see silver drop 3 in an hour and then immediately start to base or wick at a key level like 83, your brain should be screaming shakeout. This is the strong hand perspective, recognizing that the fundamentals haven't changed, only the temporary sentiment has. To master this mental game, you must look at the volume and the depth of the retracement. In a healthy uptrend, a shakeout will typically occur on a massive spike in volume, representing capitulation. Once that volume peak is hit, the selling pressure vanishes because everyone who was weak has already been forced out. If the price holds at a major historical level, like our 83 line in the sand, it is a signal that the trend is still intact. Professionals use the Fibonacci retracement levels to stay grounded. As long as silver stays above the 50% or 61.8% retracement of the previous move, the bull market is technically healthy. It says it of us only when the price breaks these levels and stays below them on decreasing volume that you should start worrying about a reversal. The psychology of the strong hand is also rooted in understanding the concept of price versus value. The weak hand focuses entirely on price, the flickering number on the screen. When the price goes down, they feel they are losing value. The strong hand focuses on the value of the asset relative to the macro environment. They ask themselves, is there suddenly more silver in the world? Has the solar industry stopped buying? Is the debt crisis solved? If the answer is no, then the lower price is simply a discount on the same value. This shift in perspective is what allows a strong hand to sit through a violent COMEX flush without flinching. They realize that the red on the screen is an invitation to accumulate more of a scarce asset at a better price. One of the most effective ways to avoid selling at the bottom is to practice time frame decoupling. Most panic occurs on the 1 minute, 5 minute, or 1 hour charts. When you're zoomed in that far, a $2 drop looks like the end of the world. But when you zoom out to the daily or weekly chart, that same drop looks like a tiny blip in a massive multi-year uptrend. The strong hand lives on the weekly chart. They know that as long as the weekly trend of higher highs and higher lows is maintained, the daily noise is irrelevant. They use the daily volatility to find entries, but they use the weekly structure to stay in the trade. Finally, you have to recognize the bull trap and bear trap mechanics. A shakeout is often a bear trap. It lures people into shorting the market at the very bottom, thinking the crash is just beginning. Once those shorts are trapped, the market reverses and squeezes them, providing the fuel for the next leg higher. By staying calm at $83, you aren't just holding. You are refusing to be the fuel for the next rally. You are choosing to be the passenger instead of the engine. Mastering this mental game is the difference between being a victim of the COMEX and being a beneficiary of it. You have to train your brain to see the flush as a necessary cleansing, a moment where the market is made light again so it can climb even higher. In the wake of the $83 defense, the air has changed. The violent flush didn't just test the floor, it cleared the wreckage of the old market and built a launchpad for something far more significant. To understand the road to $100, we have to recognize that the 83 level was not just a technical bounce. It was the moment the bears realized they had walked into a trap of their own making. By pushing the price down so aggressively to shake out retail investors, the shorts inadvertently created the very conditions for an explosive structural rally that is now poised to carry silver into triple digits. The primary engine of this next leg up is a phenomenon known as short covering. When the bullion banks and speculators dump millions of ounces of paper silver to trigger a flush, they are essentially borrowing the price's future momentum. But when the price hits a brick wall at $83 and refuses to go lower, those short positions become a liability. Every penny the price moves back up from 83 is a direct loss for the people who tried to break the market. As the price reclaims $84, then $85, the panic shifts from the buyers to the sellers. These short sellers are forced to buy back silver to close their positions and limit their losses. In a market where physical supply is already in a 200 million ounce deficit, this forced buying acts like gasoline on a fire. This isn't just theory, it's the mechanics of a short squeeze in its early stages. We are seeing a liquidity vacuum on the sell side. Because the $83 defense was so absolute, there are no longer any significant sell limit orders until we get much closer to 90. The bears have exhausted their ammunition. When the next wave of safe haven demand or industrial restocking hits the tape, there won't be enough paper resistance to stop it. This is how you get those gap-up mornings where silver opens 2 or 3 higher than it closed. The $83 floor has essentially cauterized the market's downward potential, leaving the path of least resistance pointing straight up. Beyond the technicals, the life after the flush is defined by a massive shift in global sentiment. For the last decade, the 50 mark was the holy grail of silver, the peak of 1980 and 2011 that seemed impossible to surpass. But in 2025, after holding $83 during a violent assault, the market has finally realized that $50 is a distant memory in the rearview mirror. We have entered a period of price discovery. In this phase, traditional valuation models break down because the asset is being re-rated by the world, central banks, and industrial giants. Silver is no longer just gold's crazy cousin. It is being recognized as the critical mineral of the 21st century. The road to $100 is now paved with what analysts call macro confluence. We are seeing the US dollar index, DXY, break below the critical 100 level, while global debt levels continue to soar. In this environment, the smart money is looking for assets with no counterparty risk and extreme industrial utility. Silver at $83 looks like a bargain when you consider that the gold to silver ratio is still historically high. If the ratio were to return to its historical average of 50.1, while gold trades near $5,000, silver wouldn't just be at $100, it would be at $120 or higher. The $83 defense was the market's way of saying that the catch-up trade has officially begun. As we look toward the final quarter of 2025 and into 2026, the psychological barrier of triple digits is the next great battlefield. Every time silver has approached a round number milestone, it has been met with a violent flush, just like the one we saw at 83s. But each time the floor holds, the strong hands get stronger. The people who bought the dip at $83 aren't looking to sell at $80. They are looking to hold until the structural deficit forces a total revaluation of the metal. They understand that we are witnessing a once-in-a-generation transfer of wealth from paper assets to hard commodities. The $83 level will be remembered as the launch pad. It was the price where the manipulation failed and the reality of the physical market took over. For the investor who survived the flush and held their ground, the message is clear. The volatility wasn't a warning to leave. It was an invitation to stay for the main event. The road to $100 is no longer a matter of if, but when. The weak hands have been cleared, the floor has been tested by fire, and the most asymmetric trade in the history of the finance niche is finally entering its most explosive phase.